Hi, this is David Daughtrey with Copperwind Financial. We're going to do another Dave's Talk today, and what I wanted to talk to you a little bit about is the two reasons that the market's struggling this year. The first is the fear of inflation, the second is the trade war, and I'll address both of those. At the start of this year, what we had is we had a market that was very optimistic. The tax bill had gone through, earnings were good, unemployment numbers were good. Everybody thought this could be a good year. But by the 26th of January, it had been a great year already. The market, the Dow was up over 7%, and people were talking about, oh, this might be a 2013 when the market goes up 20 to 30%. Well, with all the tax benefits and the good earnings, everybody said this will continue a long time. Well, by February 2nd, the jobs report came out. Now, the jobs report had good unemployment numbers. It had good first-time claims for unemployment numbers. It had good jobs growth for January, and the market tanked. So why the drop? Well, an obscure piece of that report that we really haven't paid much attention to the last 7 or 8 years, but because it's been very benign, is the average hourly wages, which are calculated from year over year. And they came in at 2.9%. Now, why was this important? Because the Fed, their target rate for inflation is 2%. And the market immediately started looking and reading into that, that if the Fed sees a 2.9% wage increase, they're going to think that's going to ultimately go into inflation, which is above their 2% rate. Therefore, they're going to raise rates faster and further than anybody thought. Rates going up, that's bad for the market typically, because it usually increases mortgage rates, so the number of people buying houses goes down, and all the ancillary business that goes along with that, furniture, appliances, all carpet, all the other things that go along with that get impacted. Also, interest rates go up. It costs more to buy a house, and also to buy a car. Most people finance a car. Also, corporations borrow a lot of money. If the interest rates go up, their costs go up on the interest, and therefore their earnings go down. Governments have borrowed a ton of money, and so what happens? Their deficits go up, and their services go down, and what they buy also goes down. So therefore, the markets are negatively impacted. This average hourly wage is computed by looking at the weekly wage and dividing it by the number of hours worked. Now, what happened is the market sold off about 12%. If you look at the Dow from where it peaked at 7% on January 26th, it sold off about 12%. By the first week of March, when the February numbers came out, they came in at 2.6% on the wage growth. And people said, oh, it's much better. And so the market started recovering. And in April, the same thing. It came in at 2.7%. I will tell you, those numbers are so close that I don't think it matters a lot. And I'll tell you why. Because what they do is they take the average the average weekly wage, and they divide it by the average hours worked that week. Well, that's a fairly stable number, but in February and April, when they announced those numbers, the average hours worked had gone up by, I think it was 12 minutes and 7 minutes. That therefore skewed the number down. If you look at the average weekly wage, it hadn't changed at all. In fact, it had gone up a little bit. So we'll have to watch out for May, because if it goes back to where it was in January, those numbers will probably be north of 3% potentially, and that would be a real problem for the market. Now, the second issue is a potential trade war. President Trump came out with tariffs that he is proposing to impose on imports initially of aluminum and steel, 20 to 25%. That took everybody by surprise. He's since backed away on some of it, from at least given some leeway, in that, like Canada and Mexico, he said we won't impose it there until we renegotiate the NAFTA agreement. With Europe, he's proposed that they wait until the summer to give time to do some negotiations there. But China is where we have our biggest trade deficit. If you look at our total trade deficit, depending upon which year you're looking at, is between 500 and 800 billion dollars a year, and that just means we're buying more stuff than we're selling overseas. And so when you look at China, out of that 500 to 800 billion deficit, 370 billion of it is with China. We have been buying a lot from China for a long period of time. And the trade agreement that we have with them is not very good. And so what Trump has done is he said, we're going to impose these tariffs. The problem is that if you unilaterally impose tariffs, your counterparty, in this case China, is going to also put tariffs in place. And they have proposed tariffs on a lot of things, including aircraft. Well, if you're Boeing and you're selling 737s and 787 Dreamliners to China's airlines, which has the best, the highest growth market in the world, you add 25% tariff, you're not going to sell another plane over there ever. Airbus will take that market. So they're going to hit us where it's most painful for us. The other thing that they've talked about is agricultural products. They import a whole lot of soybeans. And I think they're doing that deliberately from a political standpoint, because most of the agricultural states were clearly supporters of Trump during the election. So I think that's why they're targeting some of those. Now, if this results in ultimately negotiating a better deal with China, it'll be beneficial for everybody. But if there's a trade war, everybody loses. And we saw that during the Great Depression, where we put up tariffs, other people put up tariffs, and everybody was worse off. So hopefully cooler heads will prevail here, and we'll get some better negotiations in some of the trade agreements, and it'll be beneficial for everybody. But when we look at China, we look and say, well, they're getting the better end of this deal. Well, for the last 20 years, we've been importing cheap imports from them, and that's kept our inflation down. So they've effectively exported low inflation and deflation to us that have helped the consumers. But the cost has been manufacturing jobs. The other thing on the trade with China is we pay them in dollars, and they take those dollars and they reinvest in U.S. Treasuries. They've been financing a big chunk of our budget, our deficit. And so right now they hold $1.2 trillion worth of our debt. So we have been getting something out of it, even though it sounds like we're getting the short end of the stick. But the question is, can we make it a little bit more reasonable? If we can, things settle down there, and on the inflation front, the markets can go up. Otherwise, this may rattle the markets for a good time to come. So we'll have to watch and see. But I would really watch the May reports and then the June reports on the average hourly wage, because if it goes up significantly above the 2.6, 2.7, I think the markets are going to struggle, because the Fed will raise rates faster. So that's my take on the two reasons the market's struggling. Hope you enjoyed this. You can see us at copperwindfinancial.com or give us a call. Thank you.